Thank you for joining us today. We will begin momentarily. We are proud to be launching our new series of Learn-In webinars, as well as mentoring and coaching circles led by industry experts from our Nasdaq Entrepreneurial Center community to help you solve your most pressing issues while facing immediate changing circumstances and adversity. We want to thank you again for joining us for Finance Optionality with our Executive Director, Nicola Corzine. We will go ahead and begin in a few minutes and let some other people join us. Okay, thank you again for joining us. We have about 20 attendees right now. So again, I'll just kind of go over, we are proud to be launching our new series of Learn-In webinars, as well as mentoring and coaching circles led by our industry experts from our Nasdaq Entrepreneurial Center community to help you solve your most pressing issues while facing immediate changing circumstances and adversity. Thank you again for joining us today for Finance Optionality with our Executive Director, Nicola Corzine. And without further ado, please join me in welcoming our Executive Director.
Thank you so much, Olivia, and thank you to everyone who's joining us here today. I'm absolutely thrilled to be connecting with all of you on this important topic, not just in today's moment, but probably taking on a very important tone for many of you right now. Before we begin, we're a big fan of trying to understand who's with us in this new virtual world that we're engaged with. So I'd love to invite you, if you can, to please go ahead and put in the chat box where you're joining us from today. We'll continue to do this as new people join us. And again, thrilled to be welcoming you to our Finance Optionality webinar today. We are going to have some materials available for you during this session, and then as follow-up, they'll be attached as well. You can find them both on our Google Drive, which we'll be putting into the chat box momentarily, as well as independent attachments that will be coming out in our follow-up email for you. Again, my name is Nicola Corzine. Thrilled to be here talking to you about finance optionality today. In the chat box, if you can go ahead and let us know where you're from. And I'm also going to hopefully launch a really quick poll just to get a very quick vibrancy for how you're feeling today. Obviously, there is so much that we're all struggling with in this moment in very real time, you more than most from an entrepreneurial base. So just love to kind of get a sense as to how we're all doing in this moment. It obviously changes. You'll see us periodically launch this poll, and it just helps us to sort of set the right sentiments and tone for how our community is doing at large. So please go ahead and feel free to join us in sharing how you're feeling, as much transparency there as possible. I'll share in our last poll that we did with Deepak Chopra last week, which was an inspiring conversation. If you haven't had a chance to check that out, please do so. You'll find it in our Facebook live stream feeds and online as well in our website. But the good news is that 75%, greater than 75% of our community were feeling that they were leaning towards sort of surviving to optimistic. And so that gives us great comfort. It also gives us a great commitment to trying to do more for our founders and our community in this time. You'll see us note at the end of this, we need to continue to hear from you on sort of what are those pressing struggles and challenges that you're faced with right now. And that will help us continue to make sure that we're delivering responsive programming for you, our founders, our entrepreneurs in this time of need. All right, so without further ado, I'm going to go ahead and close this poll. Really good to see again. I think the trend is towards optimistic and surviving. I will share these results with you guys just so that you can kind of see how we're doing today. And we have a great community that's joining us from all over all over the world. So that continues to be an inspiring place for us too. For those of you who don't know me, I'm going to give you a very short, condensed version of my very eclectic background. I think first and foremost, I hope that you know I'm an entrepreneur myself. I've actually done 3 startups. One was a standalone company. We raised no money. That was in the UK back before venture even really was a thing out of college. The second company was a Silicon Valley company that was ultimately acquired by Microsoft. And the third company is the one that taught me more than the previous 2 combined, raised way too much money, I think, in retrospect. And that company burned quickly in a downturn moment where we really hadn't been able to focus in on validation of scale on business revenue side of the house. So like we say, everyone kind of needs to learn through those moments. And I found a great deal of learnings that maybe I can share with you guys along the way. From there, I turned very quickly to a short sprint in the dark side, if you will. I did a couple of years in investment banking, really found that wasn't a love for me. I love to build, I love to get my hands dirty, but it did teach me sort of the criticality around what is needed, I think, for looking at the financial lens of health and sustainability, and what the drivers are towards an investment lens of understanding where things can be leveraged, which continues, I think, to be an important part of the engagement that I can bring to the table today, and as we discuss finance optionality. And then I found a calling by sort of going back to some early investors that had backed my second company and asking them sort of, what should I be when I grow up? And they had actually started a first-time fund in Palo Alto called Propel Partners. They were looking for somebody to come help them find really great companies and entrepreneurs to work with. And I was like, I'm sorry, there's a job where I actually get to go meet other amazing innovators and entrepreneurs and suggest to you which ones you might want to invest in. Sign me up for that. That led me very shortly thereafter to be recruited by Band of Angels, which is the oldest angel investment group in the United States. I spent 11 years there. Made about 125 investments. We're industry agnostic, only focused on high tech. I continue to be a partner in our third fund there. And one of my companies ended up getting acquired by Nasdaq. And that was sort of my foray into how I learned that Nasdaq were trying to build a nonprofit that could support entrepreneurs globally. And I think from my background of sort of realizing how lucky and how blessed I was at different points of inflection in my career to have mentors that opened doors, that made the impossible possible, that really leaned into believing that it was important to pay it forward, that I saw that it was a need and an opportunity for us and for me personally to be able to do more of that vein. 2 things that I did at Band that were inspiring and continue to inspire me. One is I was part of Startup America under the a former administration that tried to basically take best practices of Silicon Valley and make them more readily accessible and available across the country. And I saw how much people wanted to lean in and support communities of great talent wherever they may be. And the second thing that was really inspiring to me was we were one of the first angel groups that was supported by Kauffman Foundation, which is one of the great organizations for entrepreneurs. If you don't know it, high call out, shout out to Kauffman. You can find them just at kaufman.org. They continue to make all kinds of resources available for entrepreneurs for free. They're one of the great heroes, I think, in the ecosystem and industry at large. But what they had committed to doing is trying to put together all of the disparate angel groups across the US to really come up with best practices on how early stage investors, the likes of which angel groups are the earliest in many ways, could come together around best practices and guidelines for what entrepreneurs can and should expect for being treated fairly in those moments. When we started, there were 10 groups. Today, I'm inspired to say that there's 270 angel groups across the US and many hundreds more across the globe. And as a result of Kauffman and as a result of the Angel Capital Association, they really do make available resources for entrepreneurs. Again, not just because it's in the angels and investors' best interest, but because it's the right thing to do for entrepreneurs. So with that tone, the last 5 years have been probably the most inspiring. The center has been so fortunate to work with over 18,000 founders at this stage from more than 110 countries. Almost half are women, 49% of our founder base are women, and 62% are minority at large. Every industry is represented, every stage is represented, and ultimately our mantra at the end of the day is we don't have the answers, you do, and we're here to support and make sure that you have access and resource and help in the moment that you need it. We're a part part-time solution really designed and enabled to help you in your journey, because you bring so much to our communities and to our world. And so in that spirit, I hope what I get to do today is sort of share with you that even in this moment of challenge, I believe you have more options in front of you to find the right financing path that is best suited for each of you as individuals, not because a media story tells you to go one way rather than another, but because ultimately you're setting your journey and you're setting your path forward. Now, one final note, and then I'm going to click into the presentation. Again, stay tuned for those materials. You'll see a link in the chat box where you can actually access this PDF and PowerPoint presentation, as well as a worksheet that I'd love you to be able to go through at the end of this or over the coming weeks and reference back on how you can actually track the right financing path for you. We'll also make those materials available in our follow-up communication to you. And as always, all of this information will be available on our website. So stay tuned for that over the coming days. But for now, let's go ahead and get started with what we're going to call a finance optionality. So one thing to note, when we have to begin at the beginning, that you can't pass go, you can't collect $200 without sort of figuring out why it is that each of you built this company. There are many motivation factors. If you sort of believe a lot of the archetype personas of entrepreneurs, the Steve Jobs types of the world, they'll say they're usually based on ego, greed, or trying to do something right in the world. I actually subscribe to the fact that there's a whole variety of other flavors in that view that is above and beyond those three that I just mentioned. And it isn't, you know, again, for us as individuals to sort of tell you that story. It's really for you to have a moment of heart and a moment of truth as to why, in spite of the many things that you could be doing in this world right now, you're choosing to do the hard path and you're choosing to lay it all on the line to be an entrepreneur. Once you get that level of clarity, then we can start talking about your fundraising strategy. So, to be clear, I understand that while it may never be cheaper, faster, insert your buzzword, to build a company than it is in like the year 2020, the realities are it still takes money. So I'm not going to try to hide from the idea that you need to raise capital. I functionally believe that funding more than just your own pockets, usually for 99% of our entrepreneurial base, is really what's required. But that does beget sort of an assumption that I think the previous slide was trying to get at. When you think about why you're doing this, there are many lanes as to how you are an entrepreneur. You could be a side hustle entrepreneur, right? You could do this as a part-time engagement until such time as the revenue enables you to switch gears and really put that lever down and do this full time. You can do this as almost a service-based business that floats the money into your operations to be able to afford you to continue in the vein of being a full-time entrepreneur. You can absolutely and fundamentally go all in and say, I've got a period of time where I can float myself, or I can float the costs and try to raise the money that I need. So there are many subscriptions as to the path of which you take to be an entrepreneur, and one size doesn't fit all, as we know. But to come to the area of sort of, okay, Nicola, I need money. There's a few key questions that we really need to put down on paper, literally taking pen to paper here. You know, first of all, what will the money be used for? Now, I'm going to talk at it from two different lenses. I'm going to talk at it first and foremost from you, our entrepreneur lens, and then I'm going to tell you later on today, like how that needs to be conveyed if you are in fact raising capital by an outside source. And for this conversation, outside sources could mean banks, it could mean debt financing, it could mean customer-based financing, it could mean grants, and it could mean venture, including angel, friends and families, everything in between. But to begin with, you got to figure out what the money's going to be used for. So in this vein, I mean, like, do you need to hire people? And if so, do they need to make money? And if so, how much money do they need to make? Do you need to produce widgets? If you need to produce widgets, consumer widgets, tech widgets, really doesn't matter what kind of widgets. How much is, what is it going to be used for? How much money do you need to have? The next question, and you'll see this broken out in the worksheet that you'll have access to, or maybe some of you have already pulled down. The next really important part of the question is, what do you have access to? Because some of your fundraising options are honestly going to be limited by what I hate to call an asset base, but essentially it is. So there are going to be some places and spaces where honestly you need to have some sense of an asset base for you personally that you're willing to put on the line. There's two very important factors there. One is, do you have it? And two, are you willing to potentially jeopardize it? For many people, this is not an option. And for many people, I rightfully appreciate, even if it is an option, it's been a lifelong journey to get to that point, and that isn't a vulnerability that you can take on. But just knowing what you have visibility into, what you have access to, both at an asset-based level, and even more interestingly for this point of conversation, your resource, your network, your support system level is going to help you figure out the right strategy for you from a fundraising function. The third thing is, what are you willing to give up? One of my favorite conversations that I had with an entrepreneur, probably about 6 months into my role at Band of Angels, a fabulously talented multi-serial entrepreneur, but first time, and with great exits, but first time that he'd actually raised money. And we're sitting down across one of my favorite coffee shops that I miss so much in Palo Alto right now, with a great cup of coffee. And I was inviting him to sort of share what he was looking for with his investors. And he proceeds to tell me, obviously, the amount of money and what it's going to facilitate, and everything is sounding great. And I said, great, so you're really looking for value-added investors. And he has this moment of pause, and he goes, well, I don't know what that means. I just want your money. I don't actually want you in my company. And I say that a little bit tongue-in-cheek to you, but I think it is important to realize that for many, and again, for all the right personal decisions, you may not be looking for anything other than passive capital. There is a huge spectrum between passive capital and active capital. And it isn't, again, for me or for anyone else to tell you where on that spectrum you should live. But it is, if you'll do me any favor, important for you to take a moment or two to really consider those areas, because those decisions that you make at whatever inflection point have ramifications that live throughout the duration of your company, in whatever form it continues to evolve towards. So it's a very important question, understanding your boundaries, your parameters of what you're willing to give up and what you're not willing to give up. Finally, and this one now more than ever is one that I don't want to shy away from. There are so many pressures that are living around each and every one of you, family, friends, companies, employee bases, communities, nonprofits, you name it. Your current commitments, both at a personal level, at a financial level, there are, again, boundaries that you need to set as to how far is too far and how much you can or can't give up. I'll share right now, I have 2 little ones under 2. There are limitations with how far I can and can't go with the timing and my availability right now. I would love to do more in certain veins, but right now my commitment to my family in the evening hours has been set as a critical priority for me. Now I have hacks, I have workarounds, I get them to bed and then I pop on for a little bit later. But nonetheless, again, the one thing I can promise you is no 2 people have the same set of solutions that will work for each of you, but you must have a moment of calm and you must decide for yourselves where those boundaries exist. And you do that, great things will happen. But when you stumble upon boundaries, that's a really scary place. And everything that you do from a financial position is almost one of chess. I really do want you to think of it as a sequential experience and not a discrete decision. Even though it can feel like in the moment, there's no options in front of you, each option that you take and pursue has different outputs and impact areas. So I know we haven't discussed the how much money. I promise you we're going to get to it. And, you know, I think for that previous list, the one parting comment that I want to make on this slide is realizing you may still not be able to have it all. You may still find yourself that there is something that you have to give up that you would really rather not give up, because to do so means that you can take capital that you otherwise couldn't have. And I appreciate it's not a perfect world, especially not right now, but going in eyes wide open and understanding those consequences or those levers that are being pulled, you will feel that you have more confidence and you are more empowered as an entrepreneur when you realize the challenges or the opportunities that you're leaning in more towards or leaning out of as a result. All right, so let's get to the exciting part, or at least what I think is a little bit of the exciting part, your choices that you have in this moment. This is in the worksheet, but for just a momentary glimpse and without thinking about it too much, I'd love each of you to take a moment to sort of rank the following in order of priority for you. Is it more important that you secure money quickly, that you get the lowest risk or cost option of the money that you're raising? Or are you looking for like that brand prestige, that outside recognition that you as an entrepreneur are onto something? No one of these things is more important than another. Each one of these things is equally important. But the decisions that you make around which one is the most important to you today is going to set, in fact, sort of your short triage approach to who you're going to go raise money from. For example, while it's possible, although I'm going to hypothesize that everybody on this call doesn't have the perfect investor waiting for a call or sitting there waiting to talk to you, because if you did, you probably wouldn't be on this meeting right now. So if you're going to secure money quickly, I can promise you, investors are not the way. Outside venture capitalists are not going to be the ones that close money quickly. Certainly not angel investors, certainly not a syndicated angel group. That is a long process. It's a long sales cycle. It's 3 to 6 months. If you are looking for loans, there is a finite, discrete process that is repeatable and systemic, and going in how long it's going to take for you to cross that. So it may still not be as fast as you'd like, but it's certainly going to be a lot faster in that moment than it is if you were trying to go raise venture. If you think the lowest risk or cost option is the most important for you, then again, being able to ensure, assuming you're all early stage in your life cycles, right now, the highest cost factor is probably going to come from venture. And the lowest cost factor is probably going to come from loans. Completely flipped from the previous statement that we just looked at. But then again, if you're really looking for a value add individual or group that can come in and hopefully help you close sales or secure a team or do bigger things than and stand on their broad shoulders, not just on your own great expertise and insights right now, then you may reorder that by looking at the brand prestige as the most critical factor and being willing and able to potentially take a lower burn of validating interest from outsiders' perspectives. So now I want to compare that just for a moment before we get into more of the meat here to understanding, which statement you see successes, because this is the other critical sort of y-axis. So we just looked at the x-axis. Now we're going to look at the y-axis. The y-axis here to me is, are you trying to build a company which you're really passionate about doing that gives you a lifestyle? And this is not a less than word. Lifestyle is a very important word here, but a lifestyle and a design where you make your own choices and you make your own future. Are you trying to build a company that really is that scalable engine that takes off like a rocket ship, even if at the end of the day, you're not running that rocket ship? Or, and I had an entrepreneur tell me this in Milestone Makers a couple of years, so I've updated my slide as a result of this. Is your dream state like, I want to live on a beach or be on a beach in 5 years' time without many worries on my mind, enjoying my family, enjoying my friends, and getting passive income? And maybe ultimately selling that company to someone else when I'm ready to retire or move on to my next dream. All of those three things are critical. All of those three things make up the ecosystem of entrepreneurial value. No one is more important or less than the next. But again, as with the above, making the choice as to what success looks like for you personally ultimately sets into equation where you go from a fundraising strategy. So basically what you're looking at here is the risk and return profile, or your X and your Y axis. most investors look through the lens of return-driven insights. You know this all too well, so I don't need to hammer that out right now. If you were curious to understand the potential acquisition opportunities for you, if you say, at some stage, I'd really like to understand what being sold or moving on to another venture or another dream might look like, you need to sort of hyper focus in on sort of understanding what is that target acquisition company profile looking like for you. And again, I say this not because investors or loan officers or grant funders are going to be expecting you to be able to delineate that with great detail, but for yourself and for your own value chain and your own understanding of what you're bringing into the world at a financial level, you need to be able to have done that homework. And then if it is on the lifestyle company, again, set those thresholds. What does that look like? Is today's lifestyle looking differently than it might be in 3 years, in 5 years, in 10 years time? As much as you can try to lift your eyes from the horizon right now, or from the pressure points right now, to look to the horizon, it's going to be really important. So I'd like to call this kind of the Goldilocks effect. Lifestyle companies, for better or worse, typically insinuate that you have a smaller capital need than some of the other types of companies. I think the real reality when you tease into it a little bit more is that because we have a different delta on a time horizon expectation, you can be slower and more methodical in your growth approach. That means a lot of the time you can self-fund. And if you are sort of taking in additional capital to the company, it can come at different injection points. That means when you think about how you break up that capital need or those capital asks, you set different milestones perhaps than a company that is really trying to target an acquisition or target an IPO. On the acquisition front, there is a very real time pressure. That time pressure basically insinuates you're looking at a small amount of capital to get to a certain inflection point. Most notably, investors or hedge funds or PEs typically like to see a 3 to 5 year time horizon here. And then at that point in time, you're going to have enough market share or enough recognition that you're going to be valued at a certain multiple that allows you to have a reasonable return with a reasonable risk profile. Now, IPO side, obviously this one is like shoot for the stars. It is truly your moonshot type of companies. These are the ones where honestly, first question to think about from a venture perspective. I don't mean angel for a second, so I'm going to delineate angel versus venture. But if you're going down a path where you are specifically targeting venture, you have to show that you're $1 billion company. And you have to show that you're not just looking for a small amount of capital to become $1 billion company. Most investors, and we'll talk about this a little later, their business model requires injection of large amounts of capital into a company's life cycle in its first 3 to 5 years that produces the kind of outlier results that IPO companies are known for. To be fair, very few venture funds of the nature of the NEAs, Batteries, Sequoias, Kleiner, insert your favorites there, look at returns less than outliers. If they can't see a moonshot opportunity, it's not going to be the right fit for the lion's share of Sand Hill Road VCs. Doesn't mean that that's the only playing field of venture firms, and we'll talk a little bit more about those options further on. But I do think it's important to understand the most precious resource you guys all have in front of you right now, from like a crystal ball, if I was giving you a gift today, is your time. Again, you know this all too well. But how you invest your time, literally in fundraising, is the most important thing in front of you. It is worth taking the time to do this homework at the pre-front so that you eliminate the vulnerabilities, the heartaches, and the challenges of raising from the wrong sources because the fit isn't right. One of my favorite investors that I have grown to really admire and respect is a guy named Jason Johnson, who was the founder of August and Founders Den and a bunch of other really great places. And he says that finding that fit is the most important thing that he was able to do early on. And to be fair, Jason did not come at all from an environment where he was networked. But what he hyper-focused on in his first company and continues to do today is really ensuring that indication of knowing who to work with and who not to work with based on fit is right at the front. So now let's talk about the who, because again, I think who is as critical as the where in finding your target sources. So you're going to kind of roll your eyes at this one, but forgive, I still think is an important one because I got a few hacks that I want to share with you. First of all, ask your network. And so let's talk about who is in your network of people that actually have amazing advice and insights to help you figure out like who you might want to be fundraising from. First and foremost, other entrepreneurs. If you are an entrepreneur, not just in the Valley, I would say in any hub across the globe, find other entrepreneurs. This is a lonely, lonely journey. And the magic and the insights of what we've seen truly inspiring at the center is that every single entrepreneur, as hard as it may be of a road that they're on, they want to be there to support other entrepreneurs that are on that same road and that same journey with them. I know we like to blatantly call out that it's so competitive and we're so fearful of one another, but honestly, I don't see that. What I see is an incredibly supportive network of people that want to help inspire and support other people in being successful too. And it doesn't come at the expense of one another. It really doesn't. It comes as a benefit to each of us feeling that we're not as isolated and not as alone, which probably today more than ever takes on more tone. So ask other entrepreneurs, and not just those that have successfully raised. I actually like to keep sort of the scale balanced in this area. So I try to always talk to half a dozen entrepreneurs that have successfully raised in the recent period. And let me be very clear right now, I mean the last 3 months. And I like to talk to half a dozen people that have not been able to successfully raise in the last 3 months. Neither one should truncate the other, but it helps to give you a holistic view as to the challenges that are going on right now with raising money. Advisors, right? Hopefully you've all got some advisors around you. If not, think about, is there a place and a space for advisors? Even if you're in, a consumer or brick and mortar business, I hope you still have access to some great people who believe and are passionate outside of your friends, your family, your dog. Trust me, my dog is always one of my greatest advisors in general. But even at a certain lens, Pippi can only do so much. So, try to bring in the outside perspectives and have those perspectives tapped into the broader ecosystem at large. Your advisors can just be such great champions and also so insightful in thinking through like what are your target sources for fundraising. Mentors, obviously that goes without saying. Again, if you are finding yourself struggling for connecting with mentors in a moment like this, plug to the center just for a second. We're actually starting some pretty cool flash mentorship hours. Everything that we do, as you guys should all know, is free. It's pro bono. It costs nothing. It's the best access that we feel like we can provide that's based on what you're asking for right now. So please let us know who you need or what you need, and we'll do our best to try to surface it. But find great mentors. You should always have between 3 to 5 mentors around you at any one time is my general piece of advice. A couple of those should be domain experts, meaning people that are specific to your field. One should always be your champion, your coach, person that can live one idea to the next, or one company to the next, or one pivot to the next. And then a couple more should really be ancillary, rounding out your skill set in places where you may feel more vulnerable right now. And then build your dream list. This is another Jason moment of insights and inspiration. He actually says, and he's very methodical with this, and he still continues to build companies. So maybe now he's got a different Rolodex, to be fair. But he literally writes a list, and that list is no more than 12. And when he goes through that list, if he's gotten no's from all 12, and he's reflected on sort of, why am I getting no's from all 12? What he'll usually do is take a moment to pause and say, this is not the right time for me to fundraise from outside investors right now. And again, I know this slide is specifically really talking through the lens of investors, but if you're targeting, say, loans, or you're targeting grant funding, or you're targeting revenue-based insights from customer cool new models that are emerging right now, you should still put your parameters around how many you can have, how many meaningful conversations you can have. And again, this comes back to realizing your time is the greatest resource. So if you're willing to talk to 100 people, you'll find 100 people that want to talk to you. But it's going to feel frustrating, and it is going to feel downtrodden when you're not making the progress that you're looking to in the business, when you're not making the progress that you're looking to with the fundraising. And I don't want you guys to feel that way. I want you to come at it from a sense of empowerment. And you do that by sort of building that very tactical, strategic list, just like you would in sales. This is really no different. Just insert the right kind of sourcing of sales that you're looking for fundraising. You want to perform due diligence. You want to reverse engineer your connection. We all are really strong now at LinkedIn, but what else? How else can you actually find 2 referrers to bring you into each lead? And again, I'm going to say this is true even at a bank lending level, especially today. I'm absolutely going to say at a revenue, at a customer driven revenue level, where maybe your customers are upfronting some revenue to do, program development, or to try to, upfront some additional capital going in your favor. Make sure that you're looking at their channel partners. Make sure that you're looking at their influencers. The influencer of your influencer is your influencer. Redundancy, I know, but literally go find 2 people that can pull you into that conversation so that they're waiting for your call. They're like, I heard about you guys. I'm so glad you called. Tell me more about what you're working on. You want people to lean in, not lean out, no matter the funding source. Truly, no matter the funding source. I promise you can do this. And that's, again, the really important reason why you don't want that funnel to grow beyond 10 to 12, because this amount of work, this amount of tactical diligence takes time. It takes a lot of approach and thoughtfulness. And I know it's the 151st thing you have to do each day you get up. So let's keep it to a minimum, and let's really get that focus and that clarity clear. And then, try to keep building the list. So whereas, today your 10 to 12 targets could look a certain way, your company, your insights, the market, the models are continuing to move, right? Nothing in entrepreneurship stands still. That's the only truth in this field. And so as you as an entrepreneur are moving, as your business is moving, this is a dynamic list. Make sure you're going back and being informed and considerate of whether or not these are still the right targets for you. So finally, the most important question, I know, how much money should I raise? This is where we have to start flipping from that lingo earlier on around, what is it doing? Is it paying the bills? Is it helping, literally keep the lights on? Is it functionally enabling you to have the bare bones minimum for survival right now? And we need to change that dynamic from what I like to call the laundry list of things into the power of the what. And the power of the what is simply saying that you're actually doing those things and paying that money out to achieve a meaningful inflection in your business. So what we need to delineate is, what is that inflection point? When does it happen? And how much runway or flexibility do you need to know what you don't know right now? For some tech companies, this gets really convoluted really quickly because everybody wants to raise the least amount of money usually possible to eliminate the most amount of vulnerability on, giving up too much in the way of valuation. And the challenge is they don't give themselves enough cushion. And why that's important? Well, let's take for a moment this moment that we're in with COVID-19. Fundraising cycles prior to this quarter, I wouldn't actually flinch if entrepreneurs told me they were going to raise in 2 months. Right now, I would absolutely flinch if somebody told me that they were going to raise in 2 months, unless they had the perfect Rolodex and they were a previous successful entrepreneur and had backers ready to back them again. So it's really important that you give yourself cushion for what you know and what you don't know. I honestly don't think any of us could have predicted the timing of this. If we would have all raised money earlier, or we would have all done things differently. And so because we're here in this moment speaks to how critical it is that you have cushion, that you have more flexibility than not when it comes to the amount of capital you're raising. So as much as possible, I'm going to ask that we hold on the worry of being too skinny in this moment, and instead really try to make sure that you have a little cushion in support of this. Similarly, for my companies that raised last quarter, last year, that we're expecting to be able to go with, let's say, a single supply chain offshore in a certain country, and that country's supply chain shut down, and they have customers waiting for product, and they have no line of being able to get that product produced right now. There's a whole bunch more capital that they need to raise in a really difficult time to do that, even with customers. So I think as much as possible, having at least a couple of months of burn rate, in all honesty, to advance or accelerate what you don't know is a safety net. Generally speaking, in downturns, I like to encourage entrepreneurs not to think less than 12 months. So at what inflection point, at what milestone will you be 12 months from now? And then add 2 months of burn on top of that. So really you're fundraising for 14 months. And again, this is true for loans. This is true for, revenue-based opportunities with customers or with funder sources in that space right now. And it is certainly true for venture and angel. Less than that, and it's going to feel really dangerous. And then you have to think about how long it takes to raise that money, right? That's the other part of the axis that we talked about. Some places it's going to be 60 days process. And in some instances, like raising from unknown sources of venture right now, you're probably looking at a 3 to 6 month sales cycle. And speaking of that, if we're talking about angels and VCs, it's important that you try to get ahead of some of the, I call this sort of good housekeeping when it comes to getting ready to raise. There are different classes of stock. Most of you know that. I wish this is the part where I missed not actually seeing everybody. If I did, I would ask, raise hands, like how many of you are LLCs and need to change to C Corps? How many of you are C Corps and know exactly what your cap table looks like? These are questions that you should just kind of think through for yourself, and make sure that you're looking at your warrants if you are a C Corp, and you have a good option pool, because hopefully, even if you are a solopreneur and a radical innovator right now, you won't be by yourself forever. And maybe raising money is probably one of the 90% of our companies that raise in their first round are doing it to hire great talent to achieve the impossible. So chances are, if you need to hire people, you need to make sure you've got a pretty healthy option pool around you. Once upon a time, in the last downturn, I was using numbers at 15%. I think depending on where you are in your life cycle curve, that could be as small as 8% and as high as 20%. So just be fluid in that. Again, this is a place where, remember how we talked about doing those informational interviews with entrepreneurs that have raised and entrepreneurs that haven't? Ask them these questions. This is a great cheat sheet to have and a hack to ask others around, and ask your mentors, ask your advisors, ask those that know. There's certainly a big push towards convertible notes. Again, it's too early in this moment in time for me to be able to hypothesize around valuation. So I really don't want to do that. But what I will tell you is that in the last experience, priced convertible notes were what came to be. So the idea of doing things uncapped, the idea of doing things at a discount alone, historically has a really unnerving place and space for investors in markets of uncertainty. And I think no matter what, we would all agree that right now there's a certain amount of market of uncertainty that we're all faced with. And then, try not to worry too much about the pre and post valuation. I know it's difficult to do. It's a number that we all get hung up on for all the right reasons, myself most notably included. But as much as possible, try not to think about this. We kind of covered much of this. I think these are things that I don't worry about this group doing, because you're all here, you're all trying to learn, you're all hustling. In that pre-body of diligence work that we're talking about right now to find your perfect 10 to 12 sources of funding for fit, this is a place where you want to make sure that you don't have any of these quote unquote skeletons in the closet, that you've kept all of your basic protocols in place for making sure that you know what is working in market right now. You've done your due diligence, you've got your option pool, if that is your structure, ready to go. If you're an LLC, you've got all your formation docs ready to be shared with loan officers, etc. If you are planning on trying to do some revenue financing with companies, that you understand sort of what are those terms, caveats, NDA type of things that they're going to want to see, what's your relevancy with regards to materials that are co-created during this time, and try to keep ahead of those types of things. I'm going to run through this because I'm realizing it's amazing how verbose I can be. I apologize, Liz. Just a couple of things, a couple of hacks here. If you are going to change your company structure, and it happens all the time, LLCs switch to C Corp, C Corp switch to B Corp, B Corps flip to C Corps, all of these types of things. Anything is possible. Just understand it takes time and money. So if you are not yet at formation stage, slow down, make sure you do your evaluation, and try to figure out what is going to be the right one, the right level, the right opportunity for you, first and foremost, based on your values, right? Company structure and values are actually very intertwined. I had this fabulous question that was raised of me recently of like, why is it that investors always want like a Delaware C Corp? And the reality is investors like Delaware C Corp because they're investor friendly. Doesn't mean they're not entrepreneur friendly, but it does mean that there's some case law in there as to why they're investor friendly. Maybe it's interesting, maybe it's not, maybe this is not the time for it. Goodness knows you guys have got 1,000 things on your plate right now. But if you're still at a place in a space where you're trying to decide on the formation, take a few extra minutes, right? And try to dig into figuring out which one is right for you and how to do it right. On the pre-financing side, and again, we're specifically now really talking about venture and angel and outside capital support. Make sure you fill your pool on the front end, as I like to call it. No investor is going to suffer dilution, especially in this moment and especially in this time. So once you're into sort of due diligence with an investor, they're already have going to know what your option pool looks like. And they are not going to want to suffer additional dilution if you haven't got your option pool, at least at that threshold level, 8 to 12%, like we talked about. Again, historically in a downturn, it was more like a 15 to 20. So be careful on that. Don't have any indications that we're there just yet, but just keep your eyes on it. The other thing that happens, and especially in environments where I think entrepreneurs get super creative, and I admire, respect, and love all of it, your options, not paying people and trying to give them additional options can actually trip you up from what you're giving away and of future value stakes. So try to keep your eye on that prize, understanding that there are real costs to you as a founder in this moment, and try to make sure that you don't give them away too much, because otherwise, again, it's going to come out of probably your founder stock way more so than the investor side of the house. And most importantly, then when you refresh your pool, you're going to have to refresh your pool an awful lot. So be careful of where you give away your warrants, your options, your stock. Assignments. This is a little bit of a silly situation, but for most of you, I know, at least for me in my past, I was never the only founder. I always had smart people around me, especially in a tech environment. And so making sure all the assignments are being assigned to the company and not to individuals, really important. That can help things go so much faster when you do actually find that perfect source. And that perfect source is like, let's get into diligence. And you're not then trying to spend extra weeks, extra times tracking down assignments to your company. And then on diligence, I'm going to simply say that nobody's got free time ever. Entrepreneurs less so than most. But if you can try to get ahead on some of the due diligence items, you're going to get faster review, and you're also going to come across as a lot more credible and stronger in the negotiations if and when they happen with investors. Okay. And this also, by the way, is true in bank loans. So there is a checklist. There are docs. I can follow up in tomorrow's email when we send out all of this stuff anyway, and share a couple more links on like, where do I go to get like what due diligence checklists look like and where I can start storing that repository. Interestingly and ironically, they actually do have kind of a hand glove relationship with loans, especially in this moment in time too. So you'll see a lot of comparison there. Finally, we talked about this before. It is hard, and I don't think any one of us, not to be facetious on this call, would make the claim, but being a billion-dollar company isn't right for everyone, and there's actually a lot less billion-dollar companies than typically are being forced to feel like they have to pitch. And I want you to have transparency and credibility as an entrepreneur. It's the single reason why entrepreneurs are funded above all else, and it's also the single reason why they're not. So if you're not a billion-dollar company, it does not make you less than, as I've already stated. And it doesn't mean that your solution isn't so deeply valued and needed in the community and world. If anything, it probably means it's more so. But it just means that it needs to be backed up, thoughtfully presented, and making sure that you're citing the right claims for you so that it doesn't do more harm than good. Valuation methodology. This is things that we like to talk about, around a good happy hour. If we were doing this later in the day, maybe this would be a topic for interest for each of you guys. But for now, I'll just keep it somewhat light. from an investor lens, and please keep in mind, now I'm switching gears and I'm really trying to give you a little bit of intel on the investor perspective. It's actually not about the dollar written down on the term sheet. It's about the percentage ownership for the majority of us. The earlier the capital that's coming into the company, the greater the percentage that's needed. The argument for that, it's the highest risk. The reality of it is, if you're on that trajectory of raising traditional venture, you're going to raise multiple rounds. Over time, our percentage ownership as seed investors continues to get diluted. You as founders actually have alternative ways to buffer that up that I'm going to cover in just a second. But for early stage investors, we just get a smaller percentage over time, right? Which makes sense. And we like to think about valuation really as the levers to improve your valuation comes with mitigating risk. Again, pretty intuitive, but how referenceable you are as an entrepreneur. This doesn't mean you have to have multiple exits, by the way. It can simply mean that you're really a well-regarded domain expert, that you have passion, that you have grit, that you have tenacity, that you've been able to make it through tough times, including the ones that we're currently facing. Your time to the next round, the longer that runway, like we talked about, the happier, the safer, the more comforting it's going to feel to investors. Your ability to scale, the total capital that's required for this entity. You should do that, thinking of that exit slide that we looked at earlier on your XY axis. Make sure you know your comps, or at least have some hypothesis around what your exits might look like, and then figure out how much capital it's going to take for you to get to that point in exit, however you define it, not however we define it. Your team, the greatest risk and the greatest reward for investing in a founder is how magnetic each of you are around what it is that you're trying to bring in this world. That magnetism will come through knowing the people that are attracted to you. The greater the people you attract to you, the greater your credibility, the greater your valuation will be. So if you're not in market, if you don't have customers, and this isn't even FTEs, I'm not talking about payroll or bankrolling people right now. I'm saying how passionate our team, volunteers, advisors, whatever they may be around you right now. And the more magnetic you can show us, the better you're going to be in this position. And then your business model validation. How much homework have you done around the homework of being a business, right? If you are early stage and you're pre-revenue, what do we know? How can we figure out right now that you're on the right track? What does that credibility look like for you as a founder there? Number one rule most investors claim: companies don't fail on tech, they fail on execution. This is true. So how do you improve your risk factor there? This is another way in which you can kind of think creatively around not counter-affecting a term sheet, but really getting ahead of it. When you do your investor pitch, right, what can you lean into as far as how you improve your risk factor profile from an execution lens, not from a tech perspective lens if you're a tech company, or a consumer lens if you're a consumer or marketing company. So where do things get hairy? Well, unfortunately, if you are on the venture and angel investor track, you need to get a lead. And leads don't advertise themselves. There's no great list that I could share with you today on, like, here's the comprehensive Business Insider of the top 500 lead investors. I wish there was. So, make sure you're being very meticulous and thoughtful on your diligence around understanding how many investors, if you are going the investor route, are willing to be the lead investor. If you have 12 qualified leads in your pipeline of people that you're targeting and none of them are leads, you need to probably go back and try to find one or two that are willing to be the lead investor. We don't shop term sheets, not that I think any of us are worried about that right now. Focus in on those exit comps like we talked about. Don't worry about outliers on valuations or putting too much weight on one company that you've heard of that got a $500 million valuation for an idea on the back of a napkin. Not only do those things usually have other realities to them, they knew the investor, they had an inside connection. There was more than just the fact that they happened to stumble upon one another. Try not to shorten your runway by less than 12 months, especially right now. Please don't try to claim cash flow break even before you're in market, like with reductions of numbers or not proven business models out there. Give yourself greater flexibility as entrepreneurs. Give yourself greater optionality, right? We're talking about fundraising optionality. I also want you to think about creating as much optionality for yourselves as entrepreneurs in this moment. And then definitely, please don't claim it only takes 1% of the market to adopt our service, product, company, and we're going to be $1 billion company. That math is just not good math. So what is the math that works? Well, reverse engineer your 3-year financials to figure out when you're going to be in market entry. Look at the bottoms up approach far more for like understanding if you are in market, your known justified accounts, how long did it take for you to close them? What is the current price point? What might it look like for a total value return to your customer? How do you build up that full revenue cycle around that? What's the value of your pipeline? Even if they haven't converted yet, what is the math that you can justify to sort of talk about, we expect 10% conversion of our current pipeline and we've got 22 mil in the current pipeline. Amazing. So you're basically telling me you've got $2 million worth of visibility in the next 6 months, 9 months, whatever it may be. What's the value of your team? Where did they come from? What's their history? What's their domain expertise? Why are they with you in spite of being other places where they might be earning more money or earning any money, perhaps for many of you? And then look at the value of the comps, right? But I like to say, and I'll throw this one as a bit of a sticky widget, I don't like going explicitly competitor view here. I like to use kind of adjacent markets. It feels a little safer, and especially when you're pitching investors, showing how you're like another industry that had a moment of incremental value takeoff for some inflection points can be a really healthy dynamic to use, and a safer one, because you never quite know who investors are listening to as well, right? So then people always usually ask me, yeah, okay, well, give me guidelines, Nicola, around those percentages. You won't like these numbers, but I'm just going to show you sort of, this is the numbers that I often reflect. It usually, if you look at history, and by now I'm talking back to my days at Angel Capital Association, there's some fabulous research that's made available to Kaufman. Please seek it out. There's some amazing insights with the University of New Hampshire, UNH publishes these guidelines too. PricewaterhouseCoopers does a money tree report for entrepreneurs, Venture Beat does as well. So there's a ton of resources out here. You can kind of reverse engineer over history. Traditionally, Series A costs 20 to 25%, 15% at B, C, D, and E get better, as the case may be. Yes, I am serious. I know it's a lot that you're giving up. Your first round is the most expensive capital that you will raise. But remember, as founders, you have a few things in your back pocket. Option pools refresh, and all the while that founders are providing value, we're going to continue to give you additional options to keep you happy there. Founder stock has special classification above and beyond investor classes, and there are such things as double triggers. So you can get with any exit, with anything going on, you will get the ability to sort of see increases in your percentage ownership as a founder. Interestingly enough, when I first did this presentation a couple of years ago, and it continues to get updated, and I want your feedback, please, a gift to me would be, give me feedback. How can I help it go deeper and more meaningful to what you need right now in the feedback survey that we give tomorrow? If you do that for me, it'd be a huge gift. But we often reflect that you can't see around corners when it comes to finance. And I think today is a great example of that. So realizing what you're trying to eliminate or avoid or push off for as long as possible is the worry about down rounds or flat rounds, the better you're going to be. So how do you do it? Well, try not as much as possible, as counterintuitive as it seems, to worry today about the dollars that you're giving up, but instead, really reflect and consider finding value-aligned investors that believe in what you're trying to put into this world if you are going the venture and angel. And I'm, again, going to say, if you're taking money from anyone, whether it's a customer, whether it's a bank, whether it's anyone, you need to make sure that you are value-aligned with the way in which they see things. One of the hardest things in the last downturn was there was a company that had somehow managed to make it in spite the odds, and were picked up and in distribution channels and widely recognized for a great amount of revenue that they were bringing in from Sephora and everyone else. They had taken venture debt financing from a player early on, and the venture debt financing at the 11th hour in the downturn decided that they were going to claw it back. and the company had less than 24 hours to pay back the entire amount of money. And so a company that had gone from generating $5 million a year in revenue went out of business overnight because of a differential in the way in which terms had been written up. Now, should the entrepreneur have known? Sure. Was it our job as investors to think about that? Almost definitely. And honestly, I lament that one in really big ways and think about it a lot. And this is not putting a bad fitting on venture debt. Venture debt has a very important, critical place in the world. But I think what is important to think about in these moments and beyond is what are the levers and what are the reasons and what are the ways in which your financiers make decisions around how they give money and how they take money. And you need to be able to make sure that you're aligned around that sentiment now more than ever. So, raising money, it's tough, it's tricky, it's not easy. But if you don't raise money and you need that money, it's still not getting you where you need to be as entrepreneurs. So with that, oh my gosh, 1 minute to spare. We did it, guys. You hung in there. Thank you. It's been an absolute privilege. I wish we could take Q&A. Unfortunately, we're not going to do that today. But what I do want to do is collect the questions. We're going to respond to people in follow-up and maybe host office hours if you guys are up for it in another week or so. Hang in there. This is tough. This is tough on a good day. It's especially tough right now. And whatever you need from us, whatever feedback you have is a huge gift. This is all underwritten. This education, this support is all provided thanks to the generosity of our great sponsors. They're the ones that literally keep my lights on. So please look to them. They are amazing partners and they're amazing sponsors and supporters of this work and our mission and our vision in the world. And for those of you who haven't seen, we've got a great program coming up next on the next frontier of fully remote training with Everett. I actually was privileged to learn from Everett just last week, and he gave me such fabulous tips and tricks on how to make it more engaging. Hopefully some of those paid off today. Guys, again, thank you. It has been an absolute privilege, and we look forward to seeing you again. Stay safe, stay well, and we're thinking of you. Thank you for all that you're doing for our communities and our world right now. Take care.